What's up, everybody? Welcome back to the channel. Today we're going to be doing another installment of the Your Company, My Analysis series. And it's been a long time since I've done one of these, and I've been meaning to start covering the oil and gas sector a bit more on this channel just because it's one where I think a lot of interesting developments are happening right now, and we're kind of seeing it go through a critical turning point in regards to all the regulation that's being enacted around that sector. So because of that, it's an industry that I do want to focus more on. So today we're going to be looking at Pembina Pipeline, which is a midstream company. So we're going to cover the business and discuss what makes them unique, and then also take a look at some of their recent financial data, and then conclude the video as always by performing a valuation of the company to see how much one share of stock is approximately worth. So Pembina is a midstream oil company, which means they deal in transportation, storage, and terminaling of crude oil and natural gas throughout parts of Western Canada mainly. And by virtue of them being a midstream company, you can expect them to be less volatile than your average oil and gas extractors or refiners because majority of their revenue is not tied to the price of oil or natural gas. Instead, most of their revenue comes from fixed fee or take or pay contracts, as we can see right here on screen. Now, that's not to say that their volumes aren't influenced by commodity prices, because if oil and gas prices increase like they did in the past year, then upstream companies will increase their production, which means more volume through the pipelines, i.e., the midstream companies like Pembina, and thus more revenue for them. But with these take or pay contracts that they have, their customers are essentially committed to paying for a minimum volume. So even if they don't actually require it, they still do have to pay it. So it's because the company's contracts are set up in this unique way that they've been recognized by many dividend investors as being very reliable, because even if the price of oil does drop, the company will still be able to pay its dividends by way of the cash flow that they earn because of these commitments that they have as part of their contracts. Now, one interesting thing to note about them is they actually pay monthly dividends as a company, which we can see on screen here, the period part here. They're paying dividends monthly. And you'll also notice some fluctuation in the monthly dividend. That's not necessarily because they're changing the amount of the dividend they're paying. It's just because if you own the stock on, say, a US exchange, they pay their dividends in Canadian dollars, so they get converted into USD. So if there's currency fluctuation, then the dividend you receive will fluctuate. So that's why you see it fluctuating so much here. It's not actually because they're changing the amount. It's just due to Canadian dollar US exchange rate changing. And if we actually look at what their dividend has been like throughout the past, we'll go 12 years here. We can see it has been consistently increasing, except for this dip here in 2016, which if we look at what the price of oil was, so this is an oil price chart here going back 10 years, we can see it kind of correlates with what oil has done. And oil in 2016 was quite low. We can see it got to about $20 a barrel here, whereas today it currently sits at $85 a barrel. And as we all know, earlier this year it got much higher than that. So what we can see here is that during that time, they did reduce their dividends, which kind of makes sense because of what we talked about before, right? Which is their revenue isn't necessarily tied to the price of oil. Most of it isn't, at least, but their volume is, which means if there's less oil, then there's going to be less volume because the upstream companies aren't investing as much in production. They're not spending as much in capex to get more oil and capitalize on those higher prices. If the oil prices are lower, then they're going to scale back production because it's not as profitable anymore. So they need to reduce the amount they're spending in order to, not incur such large losses. So that's kind of the logic behind that. And it just goes to show that a company like this is going to be less volatile than a refiner or an extractor that earns revenues based on whatever the price of oil or natural gas happens to be. So dividends are a key focus of their capital allocation, but another one is going to be strategic acquisitions and also expanding their pipeline network through growth capital expenditures, which is something else they're doing. They're constantly, every year, pretty much having new pipeline projects come online and start earning them revenue. But strategic acquisitions are also a big part of their growth strategy, which to me makes sense because one of the key ways that they can grow as a company in, let's face it, a sector that is in secular decline is by combining with other companies to reduce combined costs and achieve synergies, and then just overall make their entities more profitable. And in order for them to keep growing, they're going to need to keep finding new avenues to deploy their capital into. And they could always try expanding production, which is something else they're going to continue to do, but strategic acquisitions are also a surefire way of doing that. So, a few examples of this, and this company does have a history of making pretty aggressive acquisitions, I would say. So, there's this one here, which was for $4.35 billion, which they acquired Kinder Morgan Canada, as well as this additional pipeline here. So, this was in 2019. And then there's also this one, which was back in 2017, which they acquired a company called Verison, which is a natural gas transportation company. And that transaction was valued at $9 billion. And acquisitions in the midstream industry in general are a trend that has been developing in the past few years and is expected to continue into the future. And whenever you see this happen in any industry, really, it's because there's opportunities for synergies there. For whatever reason, it could have something to do with tighter regulations being enacted in that industry. It could have something to do with a lack of growth opportunities in the industry, which to me kind of characterizes the midstream company a little bit. So back in 2015, there was this research note here that was published by a consulting company called Bain, which is a pretty prominent consulting company, and they basically predicted this happening. And they gave a multitude of reasons why they foresee more M&A activity happening in the midstream sector. But one of the reasons that they pointed out was just due to the lack of growth opportunities in the industry. So when growth is harder to come by, managing costs becomes very important. And by combining profitable operations, you can eliminate redundant costs like administrative expenses, etc. So to me, it makes a lot of sense why this is happening and why it will probably continue to happen in the future. Okay, so let's take a look at some financial statements now. And by the way, if you're wondering what website I'm using here, this is a website called tickernomics.com. It's a website that I created myself and it's currently free. I'm trying to get feedback from users on it, on what features I should add to it, how I can make it better, etc. So if you want to check it out and use it for yourself, then I'll leave a link in the description of this video. You can go check it out, create an account. Like I said, it's free and you can explore it and see all the functionality it has. We do have 10 years of financial statement data on Canadian and US stocks, as well as some foreign stocks. So feel free to take a look if you want to. And looking at the income statement, I want to start by looking at the operating margins here. So we can see throughout the years that their operating margins have been increasing, because back in 2013 it was 13%, then gradually rose to about 22% here, which this was when one of their major acquisitions closed. So we can see that seemed to have a pretty positive effect overall on their operating margin. But in 2020, it was extremely low, 0.07% operating margin. So we obviously know what happened that year. There was, because of that thing that happened in 2020, there was a significant reduction in demand for oil and gas. So that led to less volume for them, which is something we talked about before, right? When there's suddenly less volume for the company, they can't really control their costs effectively. They need to scale back their costs when this types of thing happen, because we can see in 2019 to 2020, their revenue dropped about 15%, which is probably something they weren't really planning for. And so they couldn't really manage their costs that well. So because of that, their operating margins really suffered. And they actually reported a negative net income that year, negative $316 million, which this is in USD, by the way. They report financial information in Canadian, but this is USD, versus 2019, which it was about 1.5 billion. So a pretty big loss there. But in 2021 they did recover, so 938 million in net income, and their operating margins were pretty much what you'd expect them to be. And what I found interesting here was, because I kind of interpreted this 2020 year as kind of like what you could interpret their break even point as. So this is how much revenue they need to earn to break even, but their revenue only grew 5% year over year from 2020 to 2021, but they were much, much more profitable. And it's because a lot of their operating expenses they reduced. So their depreciation expense, we can see it went down a lot, and then their SG&A expense went down quite a bit as well. So they did some effort in controlling their costs in 2021, which helped their bottom line a lot, probably in response to what happened in 2020. And this kind of goes to show why consolidation is important, right? Because there is quite a lot of uncertainty in oil and natural gas right now with just what's going on in the world. So you need to set up your company in such a way that you're profitable at a worst case scenario, if you know what I mean. So I think that's kind of the direction this company is trying to take. Obviously, when it comes to how they manage their cash, most of it's going to dividends, some's going to growth capital expenditures. and then maybe some acquisitions as well. And then whatever they have left over after that, they're probably going to spend on paying down some of their debt because they do have quite a lot of debt, as we'll see next when we look at the balance sheet. But that's kind of the main point I wanted to get across here is why consolidation is important because the company needs to be profitable at a worse scenario of oil prices and natural gas prices. Now, next, let's look at the cash flow statement. And for this, I want to focus on the safety of the dividend because that's probably a big concern for most dividend investors out there who are probably the people that are watching this video. Now, normally for this, you'd look at free cash flow, which is this line here. We can see what free cash flow has been for the last 10 years. And you would compare their free cash flow to their dividends that they actually pay. Now, free cash flow I'm defining here is just cash from operations minus capital expenditures. It's not unlevered or levered free cash flow. And what we can observe here is that their free cash flow has pretty consistently been below the amount of dividends that they pay, especially in these later years where we can actually see that free cash flow was negative, but despite having negative free cash flow, they were still paying dividends. So why is that? Does that necessarily mean that they can't afford their dividend? The answer is actually no, it does not, because pipelines are a little bit unique in that once they build their pipeline and it starts being used and earning money for them, they're instantly going to start earning cash flows from it and recouping their investment. So the uncertainty of those types of investments in growth capex to expand their pipeline network is extremely low. And what these companies do is match how they finance their assets with the nature of the cash earning abilities of those assets. So an asset with a long useful life, such as a pipeline, which usually lasts 20 to 30 years, that has very low uncertainty and it can easily be financed through issuing long-term debt. So the company can allocate their operating cash flow to things like dividends and then use any excess they have to pay down that debt because they use debt to finance their expansion projects mainly. And basically, they can just keep doing this until eventually they will run out of expansion projects and scale back their capex and focus on just operating their existing pipeline network that they've spent so many years building out rather than expanding it further. And basically, just keep returning cash to shareholders through dividends and using some excess to gradually pay down that debt. So, the main message here is don't be alarmed when you see this. It's a pretty similar setup to what you see with a utility company, it's pretty much the exact same concept. And those happen to also be dividend stocks typically. So yeah, that's the main message I want to get here is they can afford their dividend despite what you may see when comparing free cash flow to their dividends paid. Okay, so next thing I want to do is look at some financial ratios for Pembina. So I'll go to the ratios option of the company's feature here. And what I've done is basically have all the major financial ratios, so valuation metrics, profitability, liquidity, solvency, and then also return on invested capital and employed. And I've calculated what they are for the company specifically, and then also what they are for whatever industry they're a part of. So the industry here would be mainly midstream companies, and some notable companies would be a company like TC Energy, which we can see is down here, Kinder Morgan, which we mentioned before, which is one of the larger US-based midstream companies. Enbridge as well is included in here, so another Canadian comparable. And I've also included this option up here, which is to remove unprofitable companies from the industry average calculation. So if you want to get a more apples to apples comparison and remove some of the younger companies that, maybe they're still growing, they aren't profitable yet, and they're a bit different than the company you're looking at, then you have that option there as well. But let's look at the solvency ratios because this will tell us a bit about the financial health of Pembina. So they have a debt to equity ratio of 1.14 and the industry average is 0.95. So they're a bit more leveraged than the average midstream company, but still this doesn't really strike me as that particularly high, especially considering what we talked about before in terms of how they finance their assets, which is going to be largely through debt. Their EBIT, or earnings before interest and taxes divided by interest, is 5, and the industry average is 3.7. So they are able to pay their interest with their earnings a bit better than the average midstream company out there. But even only 5 times, I mean, speaking for all companies, that is actually quite low. But despite that, they still have a credit rating, a corporate credit rating, you can see here, of triple B, which that is a pretty strong credit rating that's considered high. So to me, this credit rating here kind of speaks to the predictability of their business, right? And how important it is that even though their earnings can only pay for interest expense a few times over, it's not necessarily like there are any imminent risk of default because they do perform such a crucial role in the energy industry, and they're always going to have revenue coming in as long as their pipelines are online, really. But there is still some risk because they are a private company, and there is the risk that maybe something happens to their pipelines, or it could be commodity risk, like if what we saw kind of happen in 2020 when commodity prices fell a lot. Those are real risks that could potentially lead to a default of the company, which is why they're not rated at the A level. But looking at the credit rating, it's a good way to kind of get a good sense of the overall financial health of the company, because the credit rating agencies, despite the scandals that have happened before during the financial crisis, they are rather reputable, and you can generally trust them. They do their due diligence as well, and this is also what their interest expense, or their interest rate that they get charged, is going to be based off of. Okay, now the final thing I want to do is perform a valuation of this company. Now, for valuing a company like this, there is going to be a bit of uncertainty because, as we saw before, they have a history of making very aggressive acquisitions, and an acquisition could really distort a valuation model that we do. So, for the sake of forecasting, I'm going to assume that they don't make any major acquisitions throughout the duration of the model. So to do this, I'll use the value a stock feature on my website here. And how it works is pretty simple. You basically just uh, open it up, and then the first thing you do is enter a company, and it's going to calculate a lot of things automatically. And I want to do a 7 year model. Generally, I do somewhere between 5 and 10 years. Anything more than 10 years doesn't really make sense because the world in 10 years is going to be very different. And when you enter it, it automatically calculates cost of capital here. So this is all automatically calculated. It is just under 7%. But if you don't want to use cost of capital, you can just edit it right down here. If you want to use your own hurdle rate, like say you use 10%, 12%, whatever, you can change it there. And I'm just going to enter my assumptions here. So generally, these assumptions are going to be based off of historical financials, because a company like this, we do have the benefit that they are pretty predictable, right? You can generally assume that revenue for the next year is going to be equal to what it was previously, plus some modest growth. And revenue is predictable because you can look at their expansion projects that they have coming online soon, and you can generally estimate it from there. But just to keep things simple, to get an idea of their valuation, I'll do 5% revenue growth. Their operating margin, we can see in recent years, has been a bit higher, so I'll move that to 25%. Their tax rate, I'll put at 21%. Now, their capital expenditures, if we look at what their CapEx had been historically, it was usually a bit higher than what it had right there, which is all these numbers that are in here is the 5 year average. So I'm going to bump this up to a bit higher than that, so 1100. Depreciation and amortization, I'll leave the same. Working capital investments, I'll leave the same. The shares, I'm assuming no acquisitions. So I'm just gonna, usually they probably have to issue shares to make acquisitions. So I'll assume 0 there. And then the terminal year cash, you can adjust this a little bit, but it doesn't really have too big an impact on the model. So I'm gonna leave this basically the same for now, or I'll increase this just slightly, and then this slightly, just because, we want to factor in some change. The terminal value multiple, I'll leave at 10. And then once I calculate it, you'll see what this does. So what it does is it calculates unlevered free cash flow. And then it also calculates a terminal year cash flow, discounts all of that back to the present to get this enterprise value here, and then it adjusts for cash, like idle cash investments the company has. It subtracts out any debt, so debt plus capital lease obligations, and then less preferred shares, to equal a equity value, and then divides that equity value by shares outstanding to get what the value of one share is. So we can see right off the bat their intrinsic value is 21.76%, and their current price is 36. So you may be thinking, well, does that mean this company is significantly overvalued? Because that's kind of what it seems. And the answer is not really. And it kind of relates to what we were talking about before, about the whole distributable cash flow thing, and how they use their operating cash flow to pay dividends, and they can get financing for when they do their growth capex. So when we're valuing a company like this, because remember their dividend yield is 5.5%, I believe, somewhere around there. So when we're valuing a company like this, we basically have to assume that their capital expenditures are kind of going to be in that steady state where they're not really growing as much. Now, it is pretty tough to determine how much of their capital expenditures are growth capex versus maintenance capex. Some companies will break this out for you, and some companies won't. And you can do some work to kind of estimate what it is. And if we take a look at their most recent annual report, we're looking at note 6, which is on capital expenditures. They do say that their pipelines, so they have a few different divisions here: pipelines, facilities, marketing, and new ventures. And throughout it, they describe that most of their capital expenditures relate to expansion. So it's of the growth variety. They didn't really say how much it's growth versus maintenance, but I can kind of conservatively assume that's about 250 million because they did say primarily there. So I think this is a decent estimate. It's going to be off a little bit, but again, what we're doing here is trying to estimate it to get a better idea of understanding this company's valuation. So if we update the model for that, now we can see the valuation makes a bit more sense. So their intrinsic value is now just under $40 per share, and their current price is 35 when we update it for that. Now, again, this isn't my prediction of what the stock is worth. I'm not trying to predict the future here. I'm just trying to explain how this company's valuation works. So you can use the tool for yourself and put in your own assumptions to decide what you think one share is worth. So hopefully I did a good job explaining that concept and why I reduced the capital expenditures. If you do have any questions on that, then just leave a comment and I'll be happy to clarify things further. So yeah, in conclusion, I can definitely see why this company is popular among the dividend investors. Like I said, the predictable cash flow, the relatively high dividend yield, and the fact that it performs an essential service, transporting oil and gas, which is something the economy is still very much dependent on and will likely be for several years, even though there are more regulations coming in that are trying to move away from being an oil and gas dependent economy. So we'll see. It'll be interesting to see how this plays out throughout the next 10 to 20 years. And they are relatively low risk with a good track record. So this one definitely seems to tick all of the dividend investor boxes. Now, personally, I'm not really a dividend investor. I like companies that are smaller, less followed companies where it's a bit easier to find and identify mispricings in their valuation and take advantage of them. But that's just me. I know everyone's different. So I hope you did enjoy this video and you found it informative. If you did, then please leave a like and subscribe if you are new to my channel and you like this type of content. And I'll see you guys in the next video.